Welcome to the Pump and Dump channel for another weekly update. This time talking about the Dow Jones, the 10-year bond, oil price, and then some oil companies, just to give some illustration as to how the meltdown in the oil price is affecting different types of companies. So looking at the Dow Jones, we of course have this long-term trend line. We had the meltdown that I outlined as a possibility back in February, and unfortunately it came to happen. Went down to 24,000 and change, I guess, and since then we rebounded to this trend line here. Got rejected, bounced off. We are staying below here. This is looking very bad. It suggests that the overall stock market has potential to keep going much lower, but of course it also has the potential of going up. The factors that would take it up, in my opinion, are not happening, and therefore I'm leaning more towards it continuing to go down. And I would imagine it to go down to this level here, 21,000, and if nothing happens there, we could, go down to not necessarily 15,000, but let's say 17,000. This is a real possibility that we go 1, 2, 3, 4, 5 down, like an Elliott wave, with a target of 17,000. Now looking at the reasons why we think it could go up, why we think it could go down. I'm just gonna have a drink. Okay, so there is news talking about possible QE, and there is news about bailouts. To keep support the industries that are suffering the most from the coronavirus labeled crisis. Of course, the real crisis is the lack of liquidity in the system, and also the fact that people who are on margin are being forced out at this point in time. They're being forced out, and it really is a factor we cannot quantify. We don't know who is on margin and how much margin they have, but things are looking really bad in terms of liquidity. So that is kind of driving down these prices, the lack of liquidity, and also the manufacturing data that I've talked about previously when I was talking about the wedge we had here. That's not a good wedge. The wedge we have here that's kind of pointing towards this decline that I kind of outlined, and how it looks so similar with how the oil price melted completely from this point here down. So in the news, there's been no quantitative easing announced, and the bailouts they've been asking. Trump was asked about bailouts, what he thought. He said he didn't want to go there yet. So for him, it's kind of saying this is not bad enough for him to think about bailouts. People are saying that there is quantitative easing happening, but apart from a 50 basis point interest rate cut, nothing this week happened. If we look at the 10-year bond here, we can see how it's made this parabolic move up. I think we had the 50 basis points rate cut, emergency rate cut announced around here, when the yields fell to about 1% on the 10-year. I think it was about 1%, but then it kept going down and lower, and it's been like 0.75 or so, or close enough. And that suggests that there was going to be more emergency rate cuts. Now, if we think about why emergency rate cuts or any interest rate cut is not QE, it really comes down to understanding what is. So QE is basically putting cash into the system, and rate cuts are marking up bonds. So emergency rate cuts, this rate cut was of course announced after the bonds had already rallied, and therefore I always stipulate the fact that I believe that the Federal Reserve reacts to interest rates repricing in the market rather than make it happen. It's like the bonds are rallied up by the banks who hold them and investors who buy them, and the banks then announce that the interest rate has gone down, and Why they do this is, of course, because if you think about banks, banks are basically, you know, a spreadsheet of assets and liabilities. When their equities on the asset side are melting, as you can see here, they need their debt to increase, and the only way to really to increase the valuation of a bond. You could say a credit rating could improve them, but you know, if you got AAA rated bonds, you can't get quadruple rated A rated bonds. You're kind of stuck there. So you can only get them up with interest rate cuts, and that's what's happening now. That's what's happening now. So we don't have QE. Bailouts. Trump said he doesn't want to go there. So there is no support in terms of the liquidity problem that we have to solve the liquidity problem, and therefore I really am 100% convinced we go down next week. Maybe not next week, but the week after. I mean, that's kind of how I see it. This is what it's suggesting to me. Now, getting into some of the details of quantitative easing, when that would be applicable, I mean, at this point in time, it's not applicable. Absolutely not. Quantitative easing is, of course, putting cash into the system in exchange for debt. Let's put this here, cash into the system in exchange for debt. So basically, someone gets cash and obliges to repay the cash plus interest. So you get $100 from the bank, and you promise to pay back 100 and let's say $102 because it's plus interest. Now this is of course a deflationary force if you think about it. So why would the banks, you know, the central bank want to do this at this point in time? There is no need for it, because we already are in a situation where, you know, there's too much debt in the system, and until we see the on the business side, like when the shale oil producers and some of the other manufacturers and companies who are struggling at this point in time, until we see the liabilities wiped out through bankruptcies on these weaker companies, we won't see QE. And the reason for that is that when you start an economic cycle or financial cycle, whatever you want to call the cycle, a business cycle, you have businesses borrowing money, and then they're spending it around to build their businesses and to build valuations for their businesses based on their earnings potential and so forth. And they have the liabilities on the other side, and then eventually, like now, we see more and more of companies are drawing down their assets. Their current assets are, you know, depleting, and they get to a stage where they have so little assets against so much liabilities that they have to declare bankruptcy. And when they default and they're not repaying this liability here, that liability is wiped off, and what remains is the cash that was initially borrowed that is still in the system. Of course, not all 100 of some of the interest has been collected, obviously, and some of the cash has been collected, but usually the strong players in the financial world, they have their cash pile, they survive, and when the liabilities are written off from the weaker players are gone. So their liabilities go, the stronger players get the cash, they pay off their liabilities, and they're looking good to go. So basically what happens in that situation is that the cash pile is increasing relatively to the debt pile, which is decreasing, until there gets a point where the cash amount is greater than the debt in the economic system, in the economy. Whereas if you start from a point of zero, you can get to a point where the cash and the debt is near balanced. So once you have too much cash and too little debt in the system, that is when QE becomes necessary, because QE basically what it does is it increases the cash pile and it increases the debt pile, and because of the interest rate factor, it brings it to a point where eventually over time the increase in the debt will drain out some of the cash. Now of course in the short term, when the QE programs come in after deflation, it creates this surge here, but eventually you get to a point where it peaks out, and then we go back into this downward spiral for another couple of years, and then we get the next QE. And this has been happening cycle after cycle. Obviously, with all the QE from 2008, 2009 to 2012, 3 QEs by the Federal Reserve. The QE4 was actually not a QE. I think it was like exchanging bonds, long-term and short-term bonds somehow. So that was not QE, real QE. So this is kind of yeah, where it's at. QE is not going to happen. Bailouts, who knows? Maybe. The thing is, we need fiscal stimulus. This is kind of what the central banks have been talking about, especially the European Central Bank. Mario Draghi said that monetary policy is at an end. It can't do any more. To stimulate the economy, there has to be fiscal spending. Fiscal spending is basically the government borrowing and then spending it into the economy to get the economy going. And in Europe, that's not happening because countries like Germany, they just don't want to spend any money. They don't want to get into the government people. They don't want to get into debt. And yeah, it's kind of a tragedy, but that's kind of how it is. So yeah, bond prices are rising. Gold prices are rising too. Gold is of course a monetary metal. I'll just talk about it quickly. Gold prices are rising. What is gold? It's really just a balancing tool for the financial system. If you have gold, you can you can mark up the price and then claim that your assets are in balance with your liabilities. This is something that banks can do. The Basel III, they can use gold as a tier 1 asset. And in terms of like looking at the deflationary picture, this is kind of why gold does well in a real deflation, because the gold price rises to keep people in a feeling that at least their gold is still going up in value, so that their money, they're not losing overall in value. So yeah, maybe I just messed that up, that last sentence, but I'm a bit tired at this hour. Now looking next at the oil price. Oil price, of course, we got to the the Iran-US potential war scenario, and since then we've been falling. We've been falling down, very similar to how the US stock market is looking. First bear flag where we are at was the, I mean, it looks like a bear flag in some ways, doesn't it? And then we kept falling down here. I think the Saudis tried to bring forward the March meeting that happened Friday and Thursday with Russia and OPEC members to discuss how they were going to address the oil price at this point in time. And OPEC wanted to cut, is the story, and Russia said no, they didn't want to participate. Maybe they were being asked to cut too much, and they didn't want to do that. So at this point in time, it looks like the oil price is down here to stay. The Russians said they were happy with the price at 40, is that what the news is saying. And in this scenario where the oil price stays, let's say, in the range here of 35, that's a crazy 3, isn't it? It's a double 3 in the 35 to 45 area. A lot of the weaker players, especially in the US shale oil companies like Montero Resources, Gulfport Energy, SM Energy, Chesapeake, there's a whole number of them. In this oil price environment, they won't survive and they will go out of business. This is kind of what the Russians are discussing and laying out. And then there are also other companies like Pioneer Natural Resources, who in the Permian, of course, where the oil, it's more of an oilier play. They have been very successful since 2009. They came from lows of like $10 a share and went up to like 230 in 2014, when the oil price, of course, went to 100. And 2018, they still managed to get back to 200. And in the last couple of weeks, they have been absolutely melting. There we go. In January, it was 150, and it's just going down. Reasons why it's going down is looking at the profile of the company. They require like $55 to $60 a barrel to be able to economically develop their oil reserves, their resources into reserves, and their proven reserves are, of a short duration, but in terms of economics, they're very good. They have like 20, $25 a barrel cost, and Diamondback is also a company similar to Pioneer Natural Resources, but before I show the chart of Diamondback, I can just show these SEC filings. We can see here on the 27th when the oil price went through the support of the triangle. You can see that the staff here, statement of beneficial ownership, they were disposing their stock. That's the VP drilling, that's the CFO, that is VP and CAO, whatever that is, all of them disposing. And the same thing happened here in January 6th at the high, $151 a share, CFO disposing. And yeah, basically they are all selling out there because they understand that in the current oil price scenario that fundamentally looked like, of course it was high in this point in time, they understood that they needed to get out, and when it broke through here, they understood what that meant for the company, and that's why they got out. Diamondback Energy is the same situation. Their proved reserve is not so great. They have to grow a lot to justify their valuation. They've been in this downward triangle for some time, and they broke out before the oil price went into the toilet on the 24th, 25th. Of course, they had a good fourth quarter. They run up against this triangle line here from low down here on November. Oh no, that was actually something else. The first quarter was here, fourth quarter. It went from 71 to 81. Yeah, 71 to 81. And then it just collapsed because they're in that situation as well. So, looking at some other ones, of course, can look at Range Resources. They are also in a triangle here. They closed up here, so there is hope that if the oil price, for whatever reason, goes up on Monday, that Range Resources could, move outside the triangle and establish itself a new range here of 286 and 220 maybe. I really can't predict the future, but that's a possibility. Another possibility is that the oil price stays low and it gaps down a bit and it stays within this downward wedge, and if it goes down much lower than it is now, it becomes a steal for the long term. Of course, they have a proven reserve that is, it doesn't need to have lots of capex to develop it. It's already there. They just need to complete the wells, and they need to just spend money on producing the oil that they have and the natural gas and natural gas liquids, and therefore they are in a situation where they don't have to grow into their valuation. They reflect their valuation at the current price, and well, maybe they're a bit above with the current $41, but if you take like 42, 43, 44, this 260 is good. It's a fair valuation on a 10% discount rate using a 0.6% NAV. So yeah, what else can I talk about? Something very important. Doesn't necessarily only apply to oil here, but it also applies to the Dow Jones and to markets in general. The news narrative, if you remember all the way up, there were all these talks about it's just a dead cat bounce, it's not going to last, when it went down here, it's going to crash. This is the wall of worry, climbing the wall of worry. Whenever the news is telling you to worry, you're climbing the wall of worry. That means you're in a bullish uptrend. And unfortunately, at this point in time, the news, in terms of the politicians talking about the coronavirus, they're saying that it's no big deal, don't need to worry about it. The economy is strong, this and that, everything is positive. These are great chances to buy. I watched this YouTube video with Dave Ramsey. He was saying, he was being asked whether they, his listeners were asking whether they should sell now, and he said no. So all the news is saying, don't sell, don't sell. Goldman Sachs told its clients, don't sell. Now this is kind of the inverse of the wall of worry. And if we go to the oil price, we have the same, of course, too. We had the Iran war threat up there. And that led to oil stocks having a premium built in, and they traded at a premium until we got to around here when the whole thing was de-escalating, and it seemed like, okay, we're not going to have a war, even though they're still firing missiles and this and that. So it did seem like, the possibility was there, but the language from Trump, for instance, was like, no, we're not going to have a war. And therefore the oil price just kept going down, and then it got to here. OPEC started talking about production cuts, and the Joint Technical Committee, or whatever it's called, was suggesting 600,000 barrels. We had a little rally up, and then we kept on cratering, and we went into the OPEC meeting, which the Russians didn't want to bring forward to February, and they said they were not going to participate in these cuts. So as we were falling down there, and this is what's happening in the Dow Jones Industrial Average at this point in time, we were falling down what I call the waterfall of hope. Because the news keeps telling you, oh, don't worry, don't sell, don't sell. Oh, buy now, it's a great opportunity. And same here, don't worry, this is no big deal, we'll rebound right back up. Well, the Federal Reserve removed its accommodative stance from their language in their meetings a few Federal Reserve meetings ago, and now we are, in oil, we've kind of done a big move down. In the Dow Jones, we are underway to doing a big move down. So it really depends on what happens now. At this point in time, OPEC was kind of the hope that this would reverse and go up. Everyone who was holding all the way down on the hope that it was going to eventually be bottoming out, was the OPEC meeting concluding some cuts, and that would somehow get the oil price to go up. All those people's hopes and dreams have been shattered, and they are kind of now in a situation where the reason why they held on or why they bought has not materialized, but the price is lower, so they have to now kind of decide, do they sell or do they not sell? And in this situation it's very tricky, because when the hope has been shattered, it's a time to buy, and that's kind of what these stocks reflect. If you look at Range Resources, it was up on a day when the oil price was at its lowest for the whole year, even lowest for a couple of years. If you go back to you have to go back to who knows when, to 2016 to see it this low. And then of course there's another company, Cabot Oil and Gas, had a really big move. I was really surprised by this. One thing positive about Cabot Oil and Gas is that they have only like 700,000 barrels of oil in their proved reserve, and 7.5 billion trillion cubic feet of natural gas. So they basically are, they should change their name to Cabot Gas. They had a big move here. I remember seeing them on the 28th here down at 13 and change, and I did not think it would go back to 16 so fast, but it did. So I'm very surprised about this. It's a good company. It's got low debt profile, but in terms of valuation, it's my opinion, it's a bit expensive. So that's the reason why I would not want to buy it. At least not at this price. So yeah, falling down the waterfall of hope. there will come a time, I think, if I'm right about this going down, when people are saying that, you know, you need to get out right now, like a Jim Cramer type thing at the bottom in 2009 said you need to sell everything if you need the money to live. You know, if this is kind of the sick thing about our system, is that it's all about like one group of people trying to trick the other group of people into doing something that's to their detriment. You know, whether it's making them, you know, after they bought high, make them sell low. Basically, like statements like you need to sell at the low when you know, when it's kind of in the toilet. You have to sell if you need the money to survive. It's basically saying that if you you know, if you are in the toilet and you are kind of in the, you know, you are poor anyway, that's for sure, if you're at a situation where you can't add when it's gone down. And it's, you know, if you think about it that way, what it's saying is that, you know, if you are of the lower class, you need to sell right now so that you can live, and we'll take it from you, and then as you cash out your, you know, your money, you can then go and buy the things that you really need, which is spending money at those stores that you've just sold. And then the people who just bought them from you, they get the gains from you spending your money. So it's kind of sick, this kind of a system where you have equities that only work, you know, for the few rather than the many over the long term. I mean, some people will say that if you just buy and hold, then you're fine, but the thing is, if you bought in the last 2 years, since 2018, if you bought regularly, let's say, let's take out this blip here in December 2018 where you could have made 1 or 2 purchases, you're basically very likely to break even or underwater, and you're at this situation where you have to ask yourself, like, if you're a long-term investor, do you really want to take a chance that it will keep going down, or do you want to have faith in the system that it will go up? I mean, the news is at this point in time the waterfall of hope. So the odds are probably that you know, you would actually want to take some out, I guess, and leave some in. Why not? I mean, it's better to, you know, have less, you know, less gains if it does actually go up than having lots of losses if it keeps going down, because if it does go down to like 17,000, everyone since the election of Trump has all their gains wiped out and is underwater from buying high and being at the situation where it's much lower. And the problem is, if we do go down to like 17,000 here, then it will take several years to just get back up to 21,000. And depending on what the monetary policy is like at that point in time, there is no guarantee that it won't stay here for a couple of years. You know, like the gold price, and then eventually it will come back up. I mean, if I take the gold price, let me just pull it up. What did we have here? We had some very similar. I remember looking at this at the time back in 2013 when I had more ounces of gold, and I sold them here, most of them. I think it was February, March, somewhere around there, or maybe it was in January. I sold them, and I watched it go down, 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 and I didn't buy them back, unfortunately. But yeah, basically I saw that this trend line here was broken. This was so apparent that this was you know, a break of trend line, and then the fundamental news was suggesting lower cost gold coming ahead, and you know, the trend line here with the fundamentals kind of guided it to go lower, and that's what it did until you know, it broke out here. Of course, coming from this 1050 level, I remember reading on one of the Bloomberg terminals at work that Goldman Sachs or so traders were like talking about only being interested at buying gold at 1050. I remember it was somewhere in here where I read that. And as you can see, of course, it's, you know, it's reflated as we go into our deflationary, you know, boom, bust, whatever you want to call it, deflationary death spiral. And how much higher will it go at this point in time? I think, you know, the fundamentals suggest it goes higher. I have a penny stock I'm hoping will do miracles for me. You know, if they find, like, you know, that they have like 1 million or 2 million ounces in their resource, or you know, their resource estimate, with a high gold price, it could be very, very good. So I think we're currently in this triangle here. I'll just get rid of this trend line because it's not really useful. We are in this upward triangle here. Was a great opportunity obviously to buy here when we had this pullback on the 2nd of March, on the Monday I think that was. And yeah, it does seem like we are teetering here, and depending on how bad things get, it could go higher, and it could actually make that $2,000 an ounce. And everyone who, you know, who bought in 2010, 2011 or 12 thinking it was going to 2000, they just had to wait like a couple of years to be proven right. But I know quite a few people had been selling here, unfortunately, and that's just how it goes. So yeah, we're in this triangle. We could of course break to the downside. It's very unlikely given the fundamentals news that's happening. I think I actually talked about which gold miners I have. Guyana Goldfield didn't work out so well, to be honest. Took an L. And African Gold Group is also down from when I bought it, but as mentioned, resource estimate comes out in about a week or two, depending on what the gold price does at that point in time. The news hitting the tape could have a very positive effect, or it could have a negative effect. Who really knows? We will see, I guess. We will see. Let's hope that African Gold Group can double or triple or quadruple or quintuple. I saw that they gave some options to some of the contractors or something like that, like 1,200,000 shares at 25 cents or so a piece. So obviously those people are happy holding the shares or the options for 5 years. They think it obviously will work out. I mean, they're off for 5 years, but you know, if they see the gains, they'll take them. And that's how you have to think about this game, is when you see the gains, you need to start taking them, if you are right. So what else can I talk about? Not much, I guess. Yeah, anyway, I hope this was informative, and if you have, of course, any questions, comments and opinions, you can leave them in the comments section. Remember, it's not investment advice or recommendations for you to buy or not to buy things that I talk about here. As you see, I am not always right, and you know, in terms of pricing and in terms of executing my strategies, I am not always successful. But yeah, these are kind of my thoughts, and I guess that's gonna do it. So if you like the content, don't forget to subscribe if you're not, and have a good day.